Good morning from London. I'm Kriti Gupta alongside Mackenzie and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Japan's LDP party fails to win a majority in parliament for the first time since 2009, impairing Prime Minister Ishiba's tax plans to fund growth and defense, all further pressuring the yen but boosting Japanese stocks. Israel struck military targets across Iran early Saturday in retaliation for a missile barrage 3 weeks ago, avoiding nuclear and oil infrastructure. Plus, we're counting down to the U.S. election. Donald Trump and Kamala Harris ramping up their campaigning, rallies across the country, and winning the endorsements of A-listers. Lizzy.
Checking in on these markets, you've got oil slumping off the back of the Israel attack on Iran. Seems counterintuitive, but of course they avoided those oil facilities, hence not as big of a reaction as you might have expected. The yen slumping on the Japanese elections, less prospect of BOJ hikes. Does that bring the carry trade back into vision? You've got futures on both sides of the pond pointing higher. The countdown to the opening trade starts right now.
The opening trade starting right now, and the focus right now on what's happening in Japan, but also the Middle East, of course, with the moves in those oil markets. The yen softer, the Nikkei up, so how we pass what happens next in the days ahead for Japan is going to be consequential. And this is all before we've wrestled with the earnings story and with the data out of the US, not to mention the budget, not to mention, of course, US elections. Kriti.
Not a boring Monday at all. Plenty to digest, and a lot of it coming from different parts of the world. And we're kind of trying to fold it all together. Let's go right to our top story here, especially coming out of Japan. Japanese Prime Minister Ishiba has promised to restore stability after his gamble on a snap election backfired. His ruling Liberal Democrat coalition failed to win a majority in parliament. Forget this, the first time in 15 years. Let's get the latest out of Japan. Alistair Gale joins us this morning. Alistair, put this into context for us. What does this do to the policy in Japan?
Well, there's really a great deal of uncertainty here. As you say, Prime Minister Ishiba has said that he wants to continue. He wants to serve out as the Prime Minister for the foreseeable future, but he's lost his majority, which means that he's going to have a tough time in Parliament. He will be relying on opposition parties to work with him on specific issues. It doesn't look like he's going to get any parties to join his coalition to bring stability. So really, we might be looking at a logjam in terms of policy making. The priorities that the Prime Minister has, including increasing defence spending through tax hikes, now look to be in jeopardy. The opposition parties have more leverage. They want things like tax cuts. So we're going to have a lot of horse trading, a lot of sort of uncertainty over the future for the economy here. And we're seeing the impact of that in markets with the yen, of course, falling. And also, you know, Japan's role in the world is under scrutiny now because who's going to be the leader? I mean, Ishiba was supposed to go to the G20, supposed to go to APEC next month, perhaps go to the US and see who wins the US election. But now the priority really is sort of dealing with these issues here in Japan. And so he needs to focus on the domestic side of things, trying to make sure essentially that his government doesn't collapse. So it's a pretty dire situation for Ishiba.
OK, Alistair Gale in Tokyo. Thank you very much indeed. I was jumping in on you, Kriti. I apologise for that. Okay. There's a couple of factors here that I think are really fascinating when it comes to Japan. One is we're kind of back to the normal of Japan politics, which is the short-lived premierships of these leaders. Yeah. And now, Ishiba is still in the post, but let's see what happens, because there's real question marks about whether or not he maintains that post. Abe had that longevity, but to some extent, in the modern history of Japan, that's relatively unusual. 18 months, 2 years is normally the kind of lifespan of prime ministers in Israel, politically, of course. And then this question is whether or not the move in the yen makes sense, given that some of the opposition parties have talked about actually moving the inflation target not to 2% but around 0%. So inflation is a factor here, and if they're concerned about inflation, then could that mean higher rates? I wonder if that's being underpriced, given that some of the opposition parties, they're concerned about inflation. To get inflation down, you need higher rates. Is that being underpriced at this point?
Well, I think it's also interesting in that this is crucial and that the LDP's majority for so long, for 15 years, and then back to 1955 is enormous here. And a lot of the reason that they're kind of losing some of that strength or historical strength that they've had is because of domestic issues like inflation inflation. Yes, the party has dealt with plenty of its scandals on its own, but it is an inflationary story at the end of the day, which, by the way, you're seeing in Europe, you're seeing in Canada. If we're talking about this idea of raising taxes to increase defense policy, where have we heard that before? Right here in Europe. And I think it's fascinating that Alistair made the point of who represents Japan at the G20, simply because when you look at the likes of the G7 in particular, and you're trying to say, well, how are we going to combat the strength of China? You have Japan, France, Germany, Canada, all looking at domestic weakness where the leadership is in peril. So in the face of a U.S. election, who outside of the U.S. takes that charge?
Yeah, and it means that you get countries that are not necessarily so strong domestically actually becoming leaders on the international stage, which has been so far Keir Starmer's advantage from the UK, weirdly, when things have been quite rocky over the summer.
He's still got a massive majority. He's still politically strong.
Spread thinly and across the country, Tom.
OK. I think we're going to move on right now to the Middle East, which is, of course, we wrestled with this over the weekend as to what to prioritise, because clearly the yen moving. But then the oil moves have been pretty significant. And to what extent this is actually a de-risking moment when it comes to this region. Oil then slumping after Israel struck military targets, and that's what's important, across Iran over the weekend, but avoided those crude facilities. For more, let's bring in Bloomberg's executive editor for the Middle East, North Africa and Russia, just covering all of that for us, Stuart Livingston-Wallace. Stuart, a busy weekend, no doubt, for you and the team. Talk to us about the fact that these attacks, the retaliation from Israel, were relatively, at least, more restrained than many, at least some, had expected. What does it tell us about the role of the US? What does it tell us about how this unfolds from here?
Yeah, good morning. So there's multiple ways you can interpret this. So yes, on the face of it, they didn't go after the nuclear facilities. They didn't go directly after the oil facilities. So that is perhaps less bearish than it could have been. However, a couple of things to bear in mind. Number one, this is far from over. So yes, Iran's supreme leader came out yesterday and was relatively restrained in his response. That doesn't mean the Iranians are not going to respond at some point in the next few weeks. Number two, Israel's still going to go after Hezbollah, it's still going to go after Hamas, it's still going to go after the Houthis and the other proxies in the region, and that in turn may provoke exactly what we've seen over the last several months, which is basically forcing Iran to show that somehow it has some capability of striking Israel. Now, again, it's had two goes and so far has failed on both of those, but that doesn't mean it can't do it again. And then the third thing to bear in mind is what exactly was Israel's strategy here over the longer term. So you saw that it took out some air defences in Syria. You saw that it took out some of the air defences in Iran. Is that effectively setting the stage, or at least warning that it could set the stage for further strikes in the months ahead if it is provoked? So those are all the things to bear in mind. In terms of that oil reaction, yes, it's a big sell-off today. I'm not sure there was much of a risk premium in there in the first place. But again, maybe the oil market is being a little bit too optimistic about what the next couple of months might look like.
All right, Stuart Livingston-Wallace in Dubai, we thank you. Really interesting to tie this into the international context. Of course, we've got the Future Investment Initiative happening in Saudi Arabia this week, big conference. Saudi and the UAE as well condemning this strike on Iran, not naming Israel. But then, you know, how does Saudi get blowback in terms of its relationships here? You know, the US signalling to Saudi that it'll help the kingdom against an attack by Iran or its proxies. And then think as well about how this feeds into the conflict in Eastern Europe. You know, if Russia helps Iran replace what was attacked here, that could trigger a surge in US and Israeli weapons to Ukraine. So it all ties together between these different wars.
Yeah, it's a fascinating one as well that we're seeing this. I'm going to bring it back to the markets here, that in that we're seeing a 5% drop in oil. This idea that the geopolitical risk isn't necessarily, we say that's not priced in, that the markets are quite complacent, but there's far more downside risk to oil prices than there is upside risk. And that, to me, is really staggering in terms of how this market is reacting to what are some pretty scary headlines, to Lizzie's point, out of the Middle East.
Yeah, I mean, top line, right? You get Israel attacking Iran, and then suddenly oil moves lower. And to some extent, that's counterintuitive because, to your point, the worst-case scenarios have been priced in, at least to some level. And so that suggests that maybe the markets have been doing their job. They're de-risking to a degree. And I wonder, Kriti, what you think about what happens if you get Trump in the White House, because his stance in that region is fascinating, given that he was the architect of the Abraham Accords, but also someone who hasn't shown much sensitivity to the plight of the Palestinians. So how that plays out and reshifts, if, of course, he's elected, could be pretty consequential.
Yeah, Citi lowering its 12-month Brent forecast to $60 a barrel. Be interesting if you see others following suit.
Yeah, a really fascinating one. At the same time, this, of course, what's going on around the world. We covered Japan, we covered the Middle East. Let's talk about what's happening right here in Europe. And that, of course, is restructuring in the auto space.
Yeah, and look, this is a reminder. You may get pretty significant industrial action on the back of this. Look, Oliver Crook in Berlin has covered this conclusively for us. But it's a really big day, really big week for VW. And we're talking about the brand VW as well as the broader group. It's the brand. They're going to be telling employees, this is the latest, Labour leaders plan to inform employees at 11 German sites about the latest negotiations on the company. So there's an expectation that employees are going to have to take a pay cut on the back of this. We already know that Volkswagen, for the first time, I believe in its history, is considering shuttering some of its plants. Yeah. And part of this, again, comes down to that brutal competition with cheap, highly innovative, tech-heavy Chinese competitors and how that unfolds. We have some new lines out of China as well, out of Beijing, in terms of trying to negotiate with car makers individually when it comes to the tariff story.
The Handelsblatt story is also really interesting here in terms of what those cost-cutting measures actually look like. We're talking about 4 billion euros, which, by the way, is not chump change for anyone that's watching. We're talking about wage increases, getting a universal 10% pay cut. Would you keep working for a company if you got a 10% pay cut no matter what you did? And the fact that this is the depth they have to go to save their company, to me, is staggering. And again, speaks to this idea that inflation, these restructuring stories from 4 years ago, are very much catching up in a lot of corporate Europe and around the world. This is going to be a topic of conversation going into not just right now into the rest of the show, but in the weeks and months ahead. Let's tell you what we've got coming up on the program today. A couple of very interesting CEO conversations. Bosch CEO will be joining us at 8:15 a.m. UK time, getting us his view on the European auto industry, how that ripples effects across the supply chain. Plus, Sika's chief, Thomas Hasler, will be laying out the construction materials company's latest earnings. Lizzy mentioned that U.S. tariff story, Does that show up in other parts of the world's kind of commodity sectors, plus the China story? All of that on the topic. We'll also be talking about markets with KPMG's UK's chief economist and BlackRock's head of EMEA investment strategy at the Open. Plus, what I'm really excited about, we're talking about the countdown to the election, 8 days away. Peter Chase from the German Marshall Fund will be with us to talk about that EU-US trade. What does that look like? Tariffs, quotas, worse, all of that on the table. Yeah, and on Tuesday, in terms of the week book, in terms of what to think about for the rest of the week, we get the US jobs data as well out of the US, so a bit of a gauge in terms of how that jobs market is shaping out. And then, of course, we're really kicking off with the tech earnings. Alphabet earnings crossing on Tuesday. Wednesday, we get the UK budget, of course. Lizzy will be all across that for us. Been described something as a make-or-break moment. Maybe a bit hyperbolic on that front, but certainly very, very significant. Meta also reporting, and Microsoft. And then you have GDP preprints out of the US and the Euro area as well. On Thursday, we have inflation data out of the Eurozone. I wonder to what extent deflation, disinflation is going to be more of the stories. We look at companies like VW pushing through 10%, potentially 10% pay cuts. Apple and Amazon also reporting on Thursday, so another bumper day for earnings. And on Friday, yes, non-farm payrolls expected to come in pretty weak, in fact, around 100,000 or so, certainly sharply down from the previous month. So to what extent that tells us about a softening labour market. Bloomberg Economics still thinks you're going to get the unemployment rate still around that 4% level. Yeah, it's a fascinating one. And well, I feel like, Lizzy, this is your time to shine here. What are you watching for when it comes to Wednesday?
We've got the expectations pretty well laid, actually, by the Chancellor when it comes to changing the fiscal rules, tax hikes and cutting public spending, or does she shift public spending perhaps to the National Health Service? But it's pretty amazing that they've managed to lay the groundwork for such a shift when you consider that these are not popular measures. Is the bond market reaction that we saw last week all there's going to be? I'm interested to ask some of
they still can't define what a working person is. If you own shares and you're working, you're not a working person.
Is Keir Starmer a working person?
Yeah. No, it's a fascinating one. I mean, these themes keep coming up. Remember what region we look at. Inflation, tax hikes, and then, of course, wage increases, unions, those negotiations.
Exactly. Well, let's get to some of the other stories that you need to know this morning. Bloomberg has learned that Boeing is planning to start a capital raise of more than $15 billion as early as today. Sources say the transaction could include shares and debt that could be converted into equity. The embattled plane maker needs the money to maintain its investment-grade rating and pay for eventual recovery from a crippling strike by factory workers. In other news, France's credit rating has been put on a negative outlook by Moody's Ratings. It's the third warning in the space of 2 weeks and comes amid the deterioration of public finances and political challenges in containing swollen budget deficits. Moody's says the decision reflects the increasing risk that France's government would be unlikely to implement measures that would prevent a deterioration in debt affordability. And Georgia's ruling party has declared victory in parliamentary elections that opponents said were rigged. International observers highlighted several shortcomings they said marred the outcome. The country's president says she refuses to accept the results of a, quote, Russian-style election. So those are some of the big stories that we're watching around the world, Kriti, this morning.
Yeah, I mean, the election story out of Georgia is fascinating as well, and it comes right on about 8 days away from the U.S. election, which, of course, has dominated a lot of the headlines over the weekend. We saw a major rally, of course, in Madison Square Garden in New York City. We had the likes of Elon Musk, Melania Trump making comments as well, not to mention Tucker Carlson, the Fox News host who most recently has interviewed Putin, among many, many others. We also got some pretty big endorsements for Kamala Harris. Bad Bunny, if anyone's, I don't know if you're familiar. Are you a Bad Bunny fan?
Jenny, didn't it?
Yes.
There we go. I am cool.
Oh, you're cool. Bad Bunny. Is it Bad Bunny, Mad Bunny?
It's Bad Bunny. Well, this is why it's important. It's not just for the music, although he is fabulous. What we do have to keep in mind is he gets a big chunk of the Puerto Rican vote. So this is something that both candidates were really looking for in terms of getting that minority vote, and specifically Puerto Ricans and the likes of Miami and other parts of the world.
Did he time it on the back? So this comedian stood up in Madison Square Garden, and some people have pushed back and said it's just a comedian. But the language that was used...
A floating island of garbage, he called Puerto Rico.
He's a comedian, OK? Yeah. Maybe the vetting wasn't very good. Is that a risk to the Trump campaign? Are we normalising some of this language?
Well, we should say that they've distanced themselves from those comments, but they chose this comedian. They knew what sort of material he likes to bring to the party. Trump's childhood friend as well calling Harris the devil at this event.
Look, you're in the last 8 days of the campaign trail. The two very different candidates taking two very different approaches. And I think what the commonality is between both of them, if they're bringing out the heavyweights, Elon Musk on one side, Bad Bunny and Beyonce on the other. I mean, take your pick. And at the meantime, you are really starting to see this coming down to the wire, something that's going to be a big topic of discussion throughout the rest of the program and, of course, in the 8 days ahead. But coming up, we're going to look ahead to this week's big bank earnings in Europe. UBS, Santander, BNP Paribas, all set to report with their numbers. Plus, of course, we're going to check on those big market stories on the day with yen and oil both very much in focus. Does one impact the other? We're going to keep an eye on that. And, of course, later, Bosch CEO Stefan Hartung sits with our very own Oliver Crook talking about autos, appliances. I'm sure the U.S. election will come up. Stick with us. Plenty more ahead. If you have any questions of your own or for our guests, send them to us. IB plus BBTV Go is the function on your terminal. This is Bloomberg. We're 40 minutes away from the opening trade. Green on the screen when you look at the futures is interesting, given that we did end, of course, Friday's session in the red. Is this simply just buying at the start of what's going to be already a very volatile week? Perhaps some of the risk sentiment folding over from Asia as well. We know, of course, Japanese assets are rallying at the moment. Risk assets are rallying at the moment, of course, off of the LDP election. That's going to affect tax plans, which is, by the way, a very familiar topic in this part of the world. Let's bring in Yael Selfin, chief economist over at KPMG, joins us around this table. Yael, a pleasure to have you on the program. Look, we're talking about taxation and the impact, of course, in Japan and the facts of the election, but it's a topic that's going to really be on our radars this week with the UK and, of course, with France if their own tax plans get voted through. I want to take a big picture approach here. How effective could taxes be in terms of funding some of the deficits, but at the expense of some of that corporate growth? How are you thinking about it?
Well, I mean, I think you do really need to be clever about your tax policy, and one of the key things, though, is stability. And what we hear from companies is they want that certainty and they want to have a longer-term horizon. So I think the trick is really sorry, we're going to help. I believe we got some technical issues. We're going to get that sorted. But in the meantime, let's bring up kind of maybe the point that she was getting to, which, of course, is I think what's showing up on the screen right now. The French debt-to-GDP ratio is going to be very crucial here when we're talking about these taxation issues, how much of it does ultimately kind of help and stem some of the issues that you're seeing in the likes of the UK and France. On the flip side, how does it hurt?
Look, you've been driving this home this morning, which is that these stories are not idiosyncratic to one nation. These are issues that have been grappled with in France, in Germany, in the UK, in Japan, and in the US, though with different dynamics at play, of course. So when you think about the UK, the balancing act for Chancellor Rachel Reeves, so we know that they're going to be increasing, for example, those national insurance contributions. That seems to be pretty clear for businesses, not, of course, for individuals. So businesses are going to have to pay a higher rate. To what extent is that going to drag on growth? On the French question, of course, this also reminds us of the risks around politics. You go for that gamble in terms of calling in that election, as Macron did, and the gamble backfires. Japan has faced the same thing, and now you face consequences in France of a government that may not stand for very long. It's not that durable, is the critique from some, given that it could be face those votes of no confidence. So you have a third ratings agency coming out and calling a warning light over French debt, because, of course, the plans are still being crystallised when it comes to the budget and the priorities of the French leadership.
And this is something that, Lizzy, you're going to, of course, be on top of course, on Wednesday. Yale, I think we can bring you back in here. Apologies for that. But let's get your take on the tax story as well. As Tom mentioned, this is a market-moving story.
Yeah, so stability is really the key. So it's not so much the short-term tax hikes. It's just how long, what horizon companies have to plan, and how stable also the political system is as part of that.
I mean, talk to us then about when we're getting these votes. Is this something that materially changes the growth outlook? And I put this in the context of the U.S. election as well, given that so much of that feels dependent on the tariff story and the quota story as well. Does that affect the domestic kind of budget discussions as well, or is that something that's still too far to really apply?
You mean in the UK or in France?
Well, in both.
Okay. Well, I think it is probably a little bit too far at the moment. I think there's plenty of other things they're looking at this stage. But when you look at the forecast and when you look at what economists are thinking of at the moment, it is definitely an important factor, looking at trade, looking at what tariffs are going to do. And we have seen the EU, at least on the EU level, politicians starting to think about it as well.
Yale, this is such a moment in the UK with the budget on Wednesday in terms of it being the first Labour budget in 14 years. Do you expect that there'll be a rabbit out of the hat moment, a la the Bank of England's independence all those years ago?
Yeah, it's a really nice question. I think not. I think the current Chancellor is going to try and play very steady and not bring extra surprises. I think we've seen quite a lot of the big picture already trailed. It is possible that this is really what we're going to get. What the tweaks are going to be in terms of the exact tax changes, it's still to be seen. But in terms of the ballpark size of change, I think it is becoming quite clear already.
So you actually think that she's done, Chancellor Rachel Reeves, a good job of expectations management? Do you think that this gilt market reaction last week is all we're going to see?
Let's hope so. I think within the envelope, she probably has done a fairly good job trailing it early and trying to put it in the context of stability. Obviously, we do need to see the details, and I think that will be very important for markets. But hopefully, that would be it.
When it comes to that infrastructure spend, because they're changing the fiscal rule in part to fund additional infrastructure, what are the long and variable lags of infrastructure spend and how that informs your view longer term in terms of the outlook for the economy?
Well, it would really depend on the type of infrastructure, but generally you would expect quite a lot of it to be after the 5 years. And therefore, just looking at it from a different perspective is actually quite important.
OK, yeah, thank you very much indeed. I believe you're sticking around. We'll get more questions to you after the break. Chief Economist at KPMG UK, Yale Selfin, staying with us. More markets next, of course, and we'll get more analysis, of course, in terms of the lead-up to this UK budget. Stay with us. This is Bloomberg. Welcome back. Happy Monday. 30 minutes from the start of the opening trade. We know there's going to be volatility likely in the bond markets, particularly when it comes to US Treasuries. We've got data coming through. We've got the announcement on Wednesday in terms of the debt issuance out of the Treasury as well. So that will be consequential. But the here and now is the focus, of course, on the European debt markets and sovereign yields. And the sell-off is there. You can see it at the front end. You can see it towards the back end as well. The front end, French oats, yields up 4 basis points at the front end at 3.08. So you're back above that 3% level at the front end when it comes to, in fact, that's the 10-year. I should say at the back end when it comes to French debt. The front end, it's more modest. You've got a yield move around 3 basis points on the front end, 238, 308 on the 10-year when it comes to French debt. When it comes to German debt, at the front end, the 2-year, 214, yields up 2 basis points. BTPs, of course, in Italy, 262 in terms of the move, yields up 2 basis points. So a bit of selling pressure coming through across these sovereign debt markets of Europe. The focus, of course, on France, given the warning that's come through from Moody's and the debt profile of that country, which we know is a concern for these ratings agencies. Talking about debt profiles, let's bring it back to the UK and bring in Yael Selfin right now, Chief Economist at KPMG UK. We've been talking about the preview and the build-up to this budget. A lot has been flagged, a lot has been trailed by the Chancellor. Talk to us about the ability for the debt markets. We touched on this, but you don't think there's any risk at this point of a budget from Rachel Reeves that provokes the bond vigilantes here in the UK?
Yeah, I mean, I think that with the change in the fiscal rules, she will probably have about 50 billion room to borrow, but she's unlikely to use all of that. Partially just because, as you said earlier, it takes time to build up the capacity to actually invest. So it's not that easy to do that fast. But also because she would probably want to pace things and not panic the markets. And therefore, if she wants to keep investment levels more or less at the same level as current levels as a share of the economy, she would probably want to spend around 25 billion, not more than that, 20 to 25 billion. I think that
is that to get to the 2.5%? Is it the 2.5% level that we're talking about?
2.4 levels,
2.4%.
that is the same as at the current levels. You probably want to stick to that. It seems safe. It seems like stability. And that seems to be within the expectations of the market at the moment.
Well, so you've got her changing the fiscal rules so she can borrow to invest, raising taxes so she can increase day-to-day spending, and promising not to return to austerity. But we don't really know what austerity means. What would she have to do to avoid being accused of returning to austerity?
It's a good question. So if you look at unprotected departments, the day-to-day spending there, if you don't want to cut that in real terms, you need to increase spending by about 16 billion. She may want to spend a little bit more than that because there's a few other things she wants to spend on. So we're thinking an envelope of around 20 billion. And that is a fair number where there's been a few speculation as to how she would get there in terms of tax increases that would not completely shock the economy.
Well, how do your clients react to what they're expecting? Tom flagged this potential rise in national insurance contributions for employers. When you're talking to clients, are they packing their bags? Which bits of this potential budget are they worried about?
I think generally, businesses would welcome stability and a growth prospects in the economy. You do need a functioning economy. For example, we do need to cut the waiting list in the NHS. There's a few things that need to be done, and I think businesses recognise that. So while if taxes go up, but services, the quality of services is addressed as a result, I think most businesses would welcome it. It's just a question of how efficiently you do that, and there's quite a few things around it that I think the Chancellor is going to put in place.
When it comes to outside of the UK, though, it just feels like I'm going to bring back to the tax story, there's this race almost for who can have the highest taxes and who can juice the corporate or even the consumer the most. You're seeing it in France, you're seeing it in other parts of Europe as well, and certainly in the UK. Does that disincentivize investment when it comes to really any of these countries when they're all trying to compete?
Well, it's not in the US.
Well, it might be. We don't know that.
We don't know that.
Yeah.
But what happened to start with was, if you like, a race to increase public debt as a share of GDP. So that's really what triggered it. We are where we are, and that needs to be addressed.
Well, let's bring that to the deficit story then, right? I mean, we're looking at down the barrel of a U.S. election, of course, in 8 days that even when we do get that result, it doesn't get inaugurated, whoever that may be, until January 20th. We've got 10 days before that, a debt ceiling that's hit. What's the worst case scenario there? What actually happens when that debt ceiling is triggered? Does it have implications for the rest of the world?
I think there's more uncertainty, which is really what we don't want at the moment.
Yeah.
Yeah, but beyond that, the key thing for Europe, it seems, is the fear around tariff, is the fear around the trade relationships overall and supply chains and how they could be disrupted.
Yeah, on the BOE, when it comes to maybe a more fiscally expansionary budget from this Chancellor on Wednesday, does that make the BOE's job more difficult in terms of the pacing of rate cuts going into 2025?
Generally, I mean, we've seen relatively positive news on inflation in the UK, I'd say surprisingly, for most. And therefore, it would be very difficult for the BOE to become more hawkish than what it is at the moment. We would still expect at least another cut this year of 25 basis points.
Yeah. OK, the markets are pricing at about 40 basis points by the end of the year. Sub 4%, interestingly, by May, on the benchmark rate for the BOE. Does that align with your view as we project out into 2025, sub 4%?
Probably yes. Yes.
OK,
I
with
think
some caution.
Yeah, I mean, it is a little bit early to tell just because of the US story as well that could impact inflation and a few other things. But if things go to plan, if you like, I think we could see 3.5 by the end of next year.
Well, in that in mind, you were talking about how well Rachel Reeves has communicated in the run-up to the budget. Do you think that actually, by contrast, the Bank of England's communications have been a bit all over the place? There's a divergence between Andrew Bailey and Hugh Pill.
Well, we're seeing slightly less communication by the BOE, which is probably better in that sense because there's less of that confliction. But overall, probably there is a little bit more room to be a bit clearer where the MPC as a whole, as a group, is.
Diplomatically put, yeah.
Very quickly, a final thought on the Fed, though. And when we're talking especially about deficits, tax rises, election risk, well, does this actively affect the rate path? I mean, there's a narrative out there that if you, regardless of where the deficit risk comes from, whether it's Trump or Kamala, it actively prices out cuts from the Federal Reserve. Do you buy that?
Well, I just think the US economy at the moment is probably quite strong, despite the labour market figures that we'll probably get later on this week, that will probably be a bit weaker just because of the storms and the strikes. Generally, the picture is relatively strong, and therefore you're probably likely to see less of a cut. So 25 basis points rather than the 50.
Into the end of the year?
Potentially.
All right. Chief economist at KPMG UK, Yale Selfin, just joining us to talk about a slew of other issues. We thank you so much, from the economics to the markets, of course. Coming up, we're going to be joined by Thomas Hasler, CEO of Swiss building materials group Sika. Discuss the outlook for the construction sector next. We're having that conversation with Yale there. Tariffs, the economy, that strength has to show up in this particular sector. We're going to have that conversation next. Stick with us. This is Bloomberg.
We are 18 minutes away from the opening trade. Futures pointing higher on both sides of the pond as we kick off the week. And let's focus in on a particular company story now. The buildings material group Sika reporting growth in profitability in their earnings on Friday. The company based out of Switzerland reported higher EBITDA, sales and gross profit for the first 9 months of 2024 and has also confirmed its full-year outlook. It's good now to be joined by the CEO, Thomas Hasler, around the table. Thomas, you're straight back from a trip to China, so it's the perfect opportunity to talk to you about the demand outlook there. I know that a lot of your products are made for the autos industry. Do you think, given what we were talking about when it came to VW, that the German car makers are going to be able to regain their footing in China?
I absolutely believe so, but it will make major efforts to do so. Looking at the dynamics in China, the Chinese OEMs, they have good traction. But I would never give up on, let's say, on the European car makers and the Germans. But they have a bit, let's say, a catch-up to do, especially on the cost side, to be competitive in a very price-sensitive market in China.
I mean, until that point, can the revenue lost from autos be made up from other manufacturing industries like renewables?
I mean, yes, we have very strong demands on the renewable side. I mean, the wind, the solar, they are good contributors. But at the same time, we also have other manufacturing industry, transportation industry, for instance. So yes, it equals out to some degree, but not all of it.
Thomas, on the China story, I was speaking to the CEO of Philips earlier. They've downgraded their outlook, and that's largely as a result of the softness in China. Very different business, of course. But he said, so Roy Jacob, the CEO of Philips, said he does not see the impacts of China's stimulus yet. Are you seeing the impacts?
No, that's pretty similar. The stimulus are out there. You know, they try very hard. We expect also on the construction side, on the infrastructure side, some significant spending, which will benefit us. But so far, it doesn't trigger down into real activity, increased activities.
On that key unit around the autos market that Lizzy touched on in Europe, how bad does it get? When does that start to bottom out? What does the picture look like in 2025?
I think here the demand for cars in Europe is absolutely, let's say, there. We have a backlog. Consumers are confused about what to buy. The incentives are missing. So they're shying away from combustion engines, but at the same time, let's say, e-vehicles are too expensive. So we have a 16 million build rate in Europe, which normally should be at 22, 23 million. So we have a massive, let's say, backlog. The fleet is aging, but that comes at some point also to an end. So we shouldn't, let's say, confuse ourselves with the, let's say, underlying demand and, let's say, the short-term consumption, which also next year probably will be soft, given the uncertainties.
So if you have that backlog, then how long does that backlog take to clear? I mean, you talk going into next year, but could it go further?
I don't think so. I believe it will probably reestablish more solid demands next year. It will require some incentives. It will require some steering from the governments in regards to give clear guidance to the consumer what is preferred. This is missing at the moment.
You made a key point around subsidies and how so many of those have been rolled back in the likes of Germany, France, certainly here in the UK as well. It is starting to be something that might show up in the United States as well. Who makes up that gap? Where does that extra funding potentially come from, or does it just not?
I'm not a big fan of this subsidizing industry. So when I look at the US, I think in the US, let's say the Infrastructure Act is an intelligent way to mobilize and bring momentum in. It is also visible. It has impact. The reshoring, as another example. These are, from my point of view, very smart incentive programs. Others are less effective. The European Green Deal is, let's say, diffused by too many legislations that have different directions to take. It's not so clear.
So 10% of your business, I think I'm going to circle back to where we started, is coming from China. 8 years ago, we talked about this risk from the tariff perspective, the COVID perspective as well has been folded into there. That kind of kick-started this reshoring story and this friendshoring story. And yet it took companies, I want to say a couple of years before they actually actively acted on investing in countries and supply chains that were closer to home.
Yeah.
Do you see that accelerating or decelerating?
Oh, this is accelerating. This is very clear. I mean, we saw it.
But that's an expensive prospect if it's accelerating. Is there money for it to accelerate further?
I mean, this is spent on de-risking, and it's not only, let's say, reshoring into the US, but it has started several years back going into Southeast Asia. Yeah. We have seen many manufacturers moving into Vietnam, into Thailand. You know, this took place. And yes, of course, overall, it is additional cost. But also you can't, let's say, just see this tension and this potential, let's say, global resetting and just be not active on it. So this definitely adds cost, but I think it is a momentum that increases. It would also happen in Europe, but Europe is a little bit in a limbo in this regards that this reshoring is much less pronounced than in North America or in Southeast Asia.
How do you think about the competitive landscape in the US? Because, of course, it accounts for about 20% of your revenue. There's lots of potential there, but then how do you weigh that up against all of the market leaders trying to gain market share there?
I love the US market. It's a very competitive market. You have to be strong. We are strong. We have a strong position in the construction chemical market. We consider us leading. And as a leader, it's in your hand. You know, you define the direction. And therefore, yes, we are investing heavily in the US, in the footprint, in the expansion. also acquisition. It's a beautiful market, but the winner takes it all. I love this mentality. In the US, we have a very strong organization, and our, let's say, second, third, and fourth are quite a distance from us.
We've been really busy in terms of M&A over the past couple of years. What's guiding your M&A strategy over the coming months?
Yeah, coming months and years, it's very simple. Our M&A strategy is enhancing our organic growth. So any prospect that helps us to elevate from a level to the next and then accelerate the organic growth, that's attractive to us. It's a platform for growth.
What's the potential when it comes to data centres for you? What is the growth potential, the revenue stream potential of data streams 5-10 years out for your business?
I mean, this is an amazing, let's say, explosion of data centres. 8,000 data centres are going to be built at the moment in the next 5 years. This may even be too low, as data are, let's say, the mine or the gold of the future, and heavy investments. It started selectively in some countries, now it goes across the board. All countries, data centers are built, and for us, data centers are, let's say, high-end construction building. From one side, they need to be, let's say, totally, let's say, encapsulated, giving the freedom to operate without disruption on one hand. On the other hand, also the decarbonization commitment of those data center owners requires that they walk the talk and also build more sustainable than
the value
traditional.
of that market for you?
Pardon?
What is the value of that data centre market for you in the medium term?
I mean, this is one segment that is a very nice segment, but it is compared to infrastructure still, let's say, a smaller section.
Okay, Sika CEO Thomas Hasler, thank you very much indeed for joining us around the set. Guys, really interesting on geopolitics, on inflation, reshoring.
Yeah, I think it's interesting that the creaking infrastructure around the world is something that makes Sika rub its hands, because it's such an opportunity for their business. And as you say, data centres, what did Thomas say? An explosion of data centres coming around the world, again, makes them rub their hands, because this is precisely feeding into their business.
And to what extent, I wonder, though, is the prospect of tariffs from Trump, that a beautiful market could be tarnished by that, the build in America for America. You've seen that strategy at play when it comes to Western firms in China. Build in China for the Chinese market. I wonder if that becomes more of a theme if you get Trump in the White House.
And it's something that is
US.
arguably being priced into these markets. Of course, you're seeing it in pieces of the FX market, not to mention the bond market as well. Let's get a little bit more perspective from that angle. Bloomberg's Rachel Evans, managing editor for FX and rates coverage for the US and Europe, joins us around the table. You have an exciting 8 days ahead of you, as we all do. Walk us through that trade in the context of what we're hearing out of Japan, the oil markets. Where does the Trump trade exist?
Yeah, so I think there's a really big focus is going to be on US markets this week. So we're having kind of obviously the setup today, we're thinking more about Japan, we're thinking about the yen and dollar yen. But when we're looking kind of at the Trump trade, it's really kind of been in those US associated assets. So we're looking at the dollar. The dollar has been very kind of, I would say, volatile, based off this idea of, do you see kind of a Trump presidency that favours tariffs, which would be something that would be dollar supportive, or do you see something that actually creates so much volatility, perhaps around kind of a disputed election result, that the dollar is not its haven of choice. But when you then look around at kind of where the other havens of choice might be, you're looking now at the yen, and perhaps it's less stable there. So I think it's been really interesting kind of seeing that sort of setup coming into a week where people are going to be looking, or 2 weeks in fact, people are going to be looking for stability and for havens, that the yen is now really not one of those places that they might look. And I think, you know, there where we're really starting to talk much more about whether we see the re-establishment of the carry trade. It feels very much like we're kind of going back in time to 3 months ago, where, you know, we hadn't then seen the BOJ doing its second hike. We hadn't kind of seen some of this, you know, election instability come through. And we were actually sort of seeing kind of the yen very, very weak. We're now back to those levels, which starts to bring intervention back into the playbook. So it may be already kind of a stressful 10 days ahead, and it feels like it's about to get more stressful.
So the yen is down 0.6% versus the US dollar at 153. It's paired some of the heavier losses of the session. What is that intervention level for you? What is the level that you're looking at then?
Yeah, so like 157 to 160 was kind of where they were intervening earlier this year. We're, as you say, kind of around 153. So we've got a ways to go, but the fact that we have now kind of retraced all of those gains that we saw kind of after that last BOJ hike, and when we saw the big unwinding carry, to me suggests that we're going to start to see people establishing new positions, new short positions. And indeed, we did see that last week kind of heading into the election. Hedge funds switched to being kind of bearish on the yen trend for the first time in a month.
And indeed, Nasdaq futures up 0.6% this morning. I just want to come to oil finally because of the developments in the Middle East. Citi downgrading the Brent forecast to $60 a barrel. How much further downside do you see, especially when you factor in the China story, the downside risk there?
Yeah, I mean, oil is always kind of this question of supply and demand, right? And I think a lot of the fundamentals for oil are pretty negative at the moment. You have the potential for OPEC to be pumping more, so they're bringing a lot more supply into the market. And then, as you point out, you've got that demand picture. And I always like to look at kind of commodity currencies when thinking about sort of oil. And sort of seeing today, there was really very little shift. So I think what you've kind of seen in sort of the Middle East developments is some of the noise being taken out of the market. And that means people are really going to focus on those fundamentals. And as you point out, those fundamentals aren't great. So I think, it remains to be seen quite how much further we could go down. But clearly down is where we're headed.
All right, Bloomberg's Rachel Evans, managing editor for FX and rates coverage for the US and EMEA, as we're looking at Brent trading down 4% at $72 a barrel, Kriti.
Yeah, it's kind of fascinating that she's talking about the yen, she's talking about oil, and for me, they're almost connected in that. Of course, we're talking about the inflation and the tax changes that may happen if Ishiba is able to actually push through some of those policy changes. But then the fact that the oil moves are actually major import costs for Japan as well, not to mention, of course, for the United States, and that's coming down. That's a positive ahead of the U.S. election.
On the inflation story, and the inflation was a key gripe, it seems, for voters, as well as the scandals, inflation, and how that informs policymaking going forward. There's plenty more coming up, of course. The Open countdown is on. Stay with us. This is Bloomberg.
Less than 2 minutes until the opening trades across Europe. We are counting down to maybe some of the major individual stock news, but from a very broad basis. Let's talk about where we went on Friday's trade. Of course, the stock 600 ending a little bit higher, but only for the United States to end on a negative close. How does that then affect what we're seeing in the futures picture and whether or not that risk sentiment ahead of a very consequential week in Europe? How does that start to shape up on this Monday morning, Tom?
Futures pointing to a positive session this Monday in Europe, up 0.6%. We passed what's going on, of course, in terms of the read across from Japan. A big earnings week, of course, and we'll pick that for you, unpick that for you. Phillips may be in focus for us. European futures then pointing against 0.6%. The FTSE 100 stuck really between the strength that's coming through for iron ore, but softness in the oil price, currently pointing up by just 0.1%. And over in France, the CAC 40 looking to gain 48 points.
Well, just zooming in on some of the stocks that may be on the move at the open, Tom, you've got the oil stocks very much in focus, given that Brent is down after that Israel strike on Iran avoided oil facilities. So mind the likes of BP and Shell. We'll also keep an eye on VW after that news over the weekend that its board has drawn up cost-cutting plans, looking to save €4 billion. If there were a red flag for the German economy, this is it. To what extent does that weigh on the DAX? We've also, of course, had the Philips earnings cutting their annual sales outlook on the weak demand from China. Tom, you were speaking to the CEO, Roy Jacobs, this morning. We'll keep an eye on those shares after their results as well, Kriti.
Yeah, it's going to be a fascinating one as well. When we talk about what is actually making up this buildup, Tom was specifically talking about that 0.6% gain that you saw in the French markets. What is that in reaction to? Is that ultimately something that's getting pared back? Remember, on Friday, France was downgraded to a negative watch over by one of the ratings agencies. So, of course, that's going to be the first time we're going to see that getting priced into the equity kind of picture. We are waiting, of course, for that early pricing as well. And as we figure that out, of course, we are going to really keep an eye on those individual stocks. Tom, I'm going to get straight to you and see how some of these individual markets are trading. Tom.
All right, let's check in on markets right now. The FTSE 100 currently up just 0.1% across these markets. The stock 600 posting gains of 0.2%, so slightly more modest upside that's come through than had been flagged by the futures. But of course, that continues to evolve as these main indexes open at just shy of 8.01 this Monday morning. The French CAC 40 gaining 0.6%, as was flagged by the futures. FTSE Mid over in Italy also up 0.6%, and over in Spain a similar picture as well. Across your sectors, top of the list. so far. Travel and leisure gaining a full 1%. Autos, interestingly, getting 0.9% of a boost. One sector in negative territory, no big surprise here, is energy, down 1.4%.
We are, it looks like, still waiting for the DAX to open. But if we just zoom in on some of these individual movers, as I said, to keep an eye on the energy, the stocks, you've got BP lower 0.2%, Shell lower 1.4% currently. We're still waiting for Phillips to start trading, but it looks like VW is currently not open. We've got all but one sector in the green this morning, as you say, travel and leisure leading the gains higher 0.9%. Energy, the only one in the red, lower 1.2% currently. And we're still, on my screen, it seems, waiting for the DAX to open.
We certainly are keeping a close eye on those automakers as well. I think you already mentioned this, but Philips shares are, of course, halted in Amsterdam trading. That's another one we're going to keep an eye on. You just interviewed the CEO as well around their China outlook. Yeah, look, this is something that's rippling across the European equity space right now. In fact, Barclays has a basket of those companies that have exposure to what is happening in China. We've seen this with the luxury makers, the luxury goods makers. We've seen this with the automakers. And now we're seeing with this key maker, of course, of health devices, Philips. And they cut their outlook for the year, and that was almost entirely down to the softness that they're seeing in China. And when I asked the CEO about stimulus and whether he's seeing an impact, the answer was no, not yet. A lack of visibility when it comes to the Chinese markets they project into 2025. And that is a story that is not unique to Philips. Right, let's bring in, on this point then, and a view more broadly on these markets, Karim Chedid, BlackRock's head of EMEA Investment Strategy. Karim, drum rolls leading up to your entrance there. Thanks for joining us around the studio. We appreciate it, bright and early on a Monday. What for you is most important across these markets this week? Is it the earnings story? Is it central banks? Is it the politics of Japan? Is it the Middle East? What are these catalysts for you as front and centre?
So for me, three things, and it's a mixture of everything you said. Of course, the central banks matter, and for that, I'm looking to the non-farm payrolls number on Friday. I'm also looking to the PCE releases. You know, we want to see how that macro picture is looking. If we look at the recent indicators, the U.S. macroeconomic data has been surprising on the upside, and we've even seen a pickup in some of the forward-looking components of the economy, like the new orders component. And this is really interesting, considering that the market pricing for the Fed rate path has been pricing out some of those rate cuts. You know, we've got only a cut and a half priced in by end of this year. So this week, macro data will matter a lot for the central bank.
Where is your view on pricing around the Fed at this point?
So when we look at the year, and obviously we started super dovish, 7 cuts priced, and then you know, we've had one jumbo cut, but then we haven't had we've had the pricing become a lot more hawkish throughout the year. I think right now the pricing has become a little bit more fair when we look at that 1.5 cut by year end. I think if you look at December, 60% probability for 25 basis point cut, that seems a bit more fair than having been in the past few weeks at a point where a 50 basis point chance was being priced.
Talk to us a little bit then about how you actually hedge all of this. And it feels like the narrative has been a very easy go long vol, because that's the only thing you can really be certain of. Are there other pockets that could be a worthy hedge?
Absolutely. So when we look at that hedge conversation, obviously you've had this environment where the S&P has not been far from all-time highs and has reached new all-time highs at the same time that the VIX, that implied volatility fear gauge index, remains elevated at 18 or so. So there's that VIX premium priced in, and then when you look at the rate volatility, and rate volatility is also high. So to your point, that vol hedging through options is something that remains popular, but I would also look at gold. If I look at the global ETF flow picture, October gave us $4 billion into gold ETFs, which is the highest month on record. And even though gold has hit all-time highs, I think we still see a lot of investors look to gold as a diversification hedge in this environment.
It has, and you can see that, of course, to your point, show up in the gold ETF, GLD, of course. Handy-dandy put up that data on my terminal. But talk us through the valuation story there, because the argument against gold is that that's really a hedge against inflation or even against the deficit as well. If you get a Harris presidency and the deficit isn't as much of a concern, or if you have, say, the China story continuing to weigh in onto gold, suddenly this 27, almost 2,800 that you're seeing on the precious metal looks very, very pricey. Why would you buy into that right now?
So I would look at it a little bit differently to the thesis that you laid out.
No,
so,
hit me.
So when we look at gold's drivers over the past year and a half, and it has been going higher and higher, its correlation to things like the dollar, the real rate has broken down. And a lot of it has come down to the steady buying from emerging market central banks. But then you look at the flow data, again, the global ETP flow data since May, and those have increased in lockstep month after month. What this tells me is that the buyers of gold have become more diversified as the investment community joins in on the buying trend. And then when I consider that gold is a non-yielding asset and that rates yields are indeed coming down, even if they're not coming down as quickly as in previous rate cutting cycles, that also reduces the opportunity cost of holding gold, which is a positive.
Karim, I want to bring it to the UK because, of course, we've got the budget on Wednesday. It could be a fundamental redrawing of the UK economy. We've talked a lot about the gilt story, but how are you positioning in terms of stocks going into it?
So we've been evolving our tactical asset allocation views on UK assets a little bit over the past few weeks. We remain overweight on UK equities with a focus on the FTSE 100. So this is very much a large cap story, although I do think there's also a lot of opportunities in small and mid, but through active investing. So FTSE 100 more through an ETF approach and then through an active investing approach for the small and mid. We have moderated this overweight a little bit in favor of the gilts. Why? Because when we think about that market pricing for the rate path for the BOE, it looks the least dovish across all the major central banks, across Fed, ECB and BOE. But the UK economy, it maybe is not super weak, but it is coming down from that point of strength a little bit. It's still supportive, but it's coming down. And so that market pricing for the BOE leaves room to own duration there in gilts.
OK, so, you know, where Andrew Bailey's talking about aggressive policy potentially ahead, but Hugh Pill a little bit more hawkish, where do you expect the rate path to actually go? Which of them is right?
Well, I look at it in the context of the market pricing, and the market pricing for the BOE looking to year-end and also to 2025 is actually more hawkish than that of the Fed. So when I think of it in the context of the UK economy versus the US economy, is that justified? I don't think so, which is why I look at a more positive duration view for gilts.
What do you think? How convinced are you about the broadening theme that we're seeing when it comes to US stocks away from Mag 7? We've got the earnings story, of course, this week, which will be illustrated for us. 5 of the 7 reporting. And since July, since the peak in July, it's actually the weakest sector, if you put it as a sector, Mag 7 versus things like utilities perform very well. Does that, as a theme, continue? How convinced are you that that pushes into 2025?
Yeah, so if I zoom out and I look at Q3 of 2024 relative to the prior 2 quarters, one big theme for us in equities, where we have remained overweight US equities throughout the year, is that breadth theme. So the S&P equal weight index, which I look at to measure that breadth theme versus just the S&P market cap 500, that S&P equal weight index has outperformed throughout Q3. It's also seen flows. I always love talking about global ETF flows, but we've also seen flows into that.
Does that continue?
Tracker. And yes, so forward looking, we do see that breadth continuing because we are seeing it come through in the earnings numbers. When we look at 2024 earnings, we are tracking double-digit growth in earnings, but with a lot more participation of various sectors, utilities, healthcare, not just tech. So more broad than last year.
What is not getting enough love right now when it comes to the bond market? What is the undiscovered gem?
In bonds, I think when we look at that, two things. When we look at the gilts conversation that I spoke about earlier, we haven't seen the flows. You know, what's not getting love, I look at positioning. We haven't seen those flows into the gilts market pick up. I think there's still a little bit of hesitation around owning gilts, especially with the event risk, with the budget on Wednesday. Perhaps after we pass that event risk, we might start to see a bit more more love come in there. And then the other one is emerging market debt. That has been entirely lackluster in positioning this year.
Well, on that point, I'm going to give you the opportunity to rub it all in for us. I saw on LinkedIn you've just been in South Africa. What was the most surprising thing you saw in terms of your market research when you were there?
You might be referring to the penguins, okay, but I also, I spoke to your colleagues also in Johannesburg, and, we have seen that there has been some tailwinds, right, for emerging markets, in South Africa included. The central bank cycle there has room to either start or continue cutting rates, depending on the market. We do caution that this is not a traditional fast rate cutting cycle. It is more on the shallower end, much like the Fed rate cutting cycle, but there are tailwinds there.
Okay, so...
Can I just ask you about the penguins before you leave? What's the penguins thing? South Africa penguins?
Well, I made the trip to see the African penguins.
Oh, to see the African penguins?
Yes, and they are as spectacular as I thought they would be.
OK, that's the key takeaway from this conversation.
I definitely think so. Forget the ETF flows. We got to care about penguins. Karim Chedid, BlackRock's head of EMEA investment strategy, joining us around the table, talking about those hedges, talking about gold, and, of course, the penguins as well. In the meantime, let's get a quick check on the major players that you were seeing in this equity market, the core six, the sensational six. I'm going to call them the sensational six. Although today, maybe not trading as sensationally as I thought. LVMH getting a lot of love this morning, higher by about 0.9%, almost a 1% move. Again, in French stocks, you are seeing that outperformance this morning, despite the fact that on Friday it was put on negative watch from a regional perspective. So it's interesting to see that there is some buying going into those stocks. On the downside, though, ASML is Novo Nordisk is the underperformer, down about 0.6%. ASML also lower by about 0.2%. Them together are the kind of underweights of this market. Let's get a quick check on some of the other individual stocks on the move. Joe Easton has our breakdown. Joe.
So we have got a big unch on the screen at the moment for Philips, meaning unchanged, as in we haven't got a price yet on that stock because there's a lot of volatility coming through. It was cooled down around 10% in the pre-markets, given that downgrade to guidance for the company, partly due to China, but also the consumer health businesses, toothbrushes, household goods, coffee makers, that kind of thing, also weak as well, missing on all units, according to analysts this morning. That is expected to be a big dropper when we do finally get a price on that one. Then we will look at Volkswagen as well, because we had that report over the weekend of a restructuring, meaning job cuts, potentially cost savings at the company. There are some issues on industrial action at the moment, but that one getting a bit of a boost today, giving that move there. Then the big story today is, of course, around this massive drop in oil that we saw overnight. Oil prices, the Brent crude price, down 5%, given the changing tone on Israel and Iran at the moment. We're seeing weakness in BP and Shell, both weighing on the FTSE 100, down around 2% almost for both of those stocks at the moment. But the boost for this, the positive of the lower oil price, is in the airlines. Some of these are the best performing stocks in Europe today. Air France almost up 6% now, seeing Lufthansa, EasyJet, IAG, all of these stocks gaining, given the lower oil price would mean potentially reduced costs in terms of jet fuel. So that is a positive for those stocks today. Then we've got one stock over in pharmaceuticals, which is just popped up on the radar. This is a maker of hearing aids, one of the biggest hearing aid makers over in Denmark. This one up 5%. A report saying Costco in the US is going to start selling their hearing aids products once again, something the market's been waiting for. Traders were flagging that one to me this morning. So that is a good stock in the market, probably just overshone by the airlines at the moment. Grifols coming down, though, staying in healthcare. There's a report saying Brookfield needs another 1.5 billion euros of cash if it's going to do the takeover of this company. They're having some finance issues. This is according to El Confidencial over in Madrid today, reporting this one, and that is weighing on Grifols this morning. Then finally, we'll do one morning call. This is an interesting one because we've got Glencore. I think we're going to check in on Glencore here. Glencore is raised to buy over at HSBC. Now, that one is up. They've got earnings out on Wednesday, so actually HSBC getting ahead and saying you should potentially be buying. Now, the producer, Mohammed, is very kindly telling me that we're going to do Philips because we have got a price on that one finally. So here it is, the big moment, Philips down 13%. That is one of the biggest healthcare companies in Europe, and it's absolutely hammered on a downgrade to guidance. A lot of that due to China, as we say. Absolutely slammed over in Amsterdam for Philips, getting hit hard this morning.
I do love Joe Easton. Do you love Joe Easton?
He's okay. Who doesn't love Joe Easton?
Joe, well done. Chelsea won 2-1 versus Newcastle.
Yeah, well, straight through. I was right there for it, and yeah, we're coming back to the top.
Fingernail stuff. Joe Easton, a lot of love for you. Thank you very much indeed for our equities team and check, of course, on what is moving this Monday morning. Coming up, the CEO of the world's biggest supplier to the auto industry, Bosch, joins the show. The interview with Stefan Hartung is next. Stay with us. This is Bloomberg. Welcome back to the opening trade. Happy Monday, everyone. We are 18 minutes into today's trading session. You're seeing positivity across European stocks, up 0.3% on the stocks 600. The CAC Garant stands out with the gains of 0.7%. More of a lacklustre session when it comes to the UK. The FTSE 100 under pressure as a result of the oil price, just up 0.1% on the FTSE 100. Over in Germany, meanwhile, gains of 0.2%, adding 41 points. Talking of Germany, let's go to Berlin right now. Bloomberg's Oliver Crook standing by with an interview with a key player from the under pressure auto industry. Ollie.
That's right, Tom. And listen, it's not just the auto industry, because this is a sort of story that sits at the very center of the biggest sort of stories we've been talking about for the last few months, whether it's AI, semiconductors, the auto industry, tariffs, and of course the German economy. So I'm very pleased to speak to somebody who really sits at the heart of all of these stories brought together. It is the CEO and chairman of Bosch, because Bosch, we should just say, in addition to being one of the biggest companies and employers in Germany, it's technology that it's in half of all the smartphones. It's almost in everybody's home, and it's in literally almost every single car on the planet. So Stefan Hartung, thank you so much for your time today. We should start in the auto industry because we have more difficult news out of Volkswagen today, and probably your order book is one of the clearest indications of what is to come in terms of demand for the auto sector. What are you seeing there?
Well, we are still growing in the auto industry also this year, but let's be very honest, the auto industry didn't grow as much as we anticipated. So the overall production of vehicles will be pretty much flat. There will be a very small growth. Just few pockets are left of growth, like India, for example, or the Chinese export. There is still some growth in the battery electric vehicles, but we see a big shift, actually. Not only that there is no volume growth, but the shift is away, actually, from the big growth numbers of battery electric cars to plug-in hybrids. So that is challenging in this industry, because if you change production programs in this industry, that's a big thing.
It takes a very long time. So do you see any reason to be sort of more optimistic about things turning around, or do you think we're in this for at least another 2 years or so?
Well, long term, we know things will change towards the battery electric vehicles, and that's a good thing. But definitely the ICE technology, so the engines will be needed longer. That's what we always thought. So there is a technology open approach now coming by the consumer, because the consumer freely decides what he wants to buy. First, you see with a flat production line that the consumer decides less, so he just waits and takes the car a bit longer, which is bad for the industry. On the other hand, the consumer is deciding to buy more plug-in hybrids, which is more to see neutral. But in the long run, I'm still optimistic full electrification will happen.
And I'd like to also get your broader picture in terms of global demand, because you're in obviously homes, you're in consumer goods, you're in obviously cars, you're in smartphones. What is the sort of picture of global demand across all of your different businesses?
Well, if you look at consumers, which drive most of it, right, which is our home kitchen appliance business, but also our power tools, consumers are hesitant on spending. You see that in China and Europe. You see it less in the US, by the way. The US consumer is always much more resilient in these terms, right? But you see in these two sectors a quite strong resilience. So people wait a moment to buy, also for cars. So in all the durables, you see that hesitation, which comes from unclear regulation or unclear view if this is good, if it's a good case for the consumer. They calculate, right? They don't just do emotional things.
Yeah, and one of the things they're obviously going to be paying attention to as well is the election in the United States. How prepared are you for potentially 10, 20% tariffs in the event of a Trump administration? Does that make you look at your manufacturing and production footprint?
Well, definitely I'm not a big fan of tariffs, right? That's clear, because tariffs kind of hinder the global collaboration, and that's important for technology. But, you know, the election brings also a certain clarity. So over the next month, some clarity will come what the direction is, and then industry will adjust. Everybody will be able to adjust also. That's a good thing by nation of the election. How the policy actually will evolve, we have to see. But in general, the US is still the strongest figures, I would say, globally. So probably the recovery is coming there fastest. The growth is coming the most eminent. So you have to be there. And that's why we shift in Bosch big time towards US investments. We did the investment for the semiconductor in California. We bought JCI and Hitachi for the air conditioning business, and that's the strategy to go.
And the other question is, of course, the Chinese economy, where we've seen a lot of distinct weakness. But I have a theory I'd like to test on you, which is that when demand comes back within the Chinese economy, is it really for the same items that we've been talking about historically? Because demand's been out for about 4 years. Is it for German ICEs, and is it for really the same components? Because China's really been trying to make its own component industry as well.
Well, China is changing from a pure production manufacturing-based system and a market for importers, right, towards a technology-based system which is driving its own innovation and bringing great product in China for the Chinese people. The consumer is extremely demanding, very high-tech driven, loves high-tech functions. So you see way more level 2+ driving, which is full automated driving, but you are still responsible. So it's a thing which is much cheaper, but still very comfortable, and you see these things in China. So the most advanced functions are now asked by Chinese consumers and customers, and that's actually a change. So will China be the same when demand comes back? Definitely not.
And then the other question I have also for you is that you said that this is going to be a very challenging year for you, the road ahead, and that obviously where demand is absent, then cost cuts need to happen. Are there going to be more cost cuts at Bosch? Where are you looking to cut costs? Are jobs on the table? You're going to have to cut some jobs.
Now, most important for us are not the cost management questions of our plan. The real core thing of the plan, which includes cost management, right, is the innovation plans, because we go for new innovation to face with better value to the consumer in different areas. So we're forced to go more to the US, we're forced to go more into new product, new innovation, and be on the forefront on these new trends, also in China, also in Europe, but also in the US.
So let's not be totally pessimistic. In terms of those new trends, where is Bosch right now spending the most in R&D? Where are you seeing that sort of promise?
Well, still a lot of money is spent for semiconductors because that's an investment-based approach, right? You need to build these factories first, right? There is one in the US and there are some in Germany we still build. And then there is obviously the electrification story, because long-term battery electric, this will be the way to go. And automation of vehicles, including full automation. But majorly, the trend is now not going for full automation, which some players show, but the semi-automation. So we are still responsible. The car does most of the work. That seems to be the way where the next wave is really coming.
And is that a category where you think you could see an acquisition, for example, in Bosch? Because you said sort of a number of times that you need to be prepared for inorganic growth. Where are you sort of looking at inorganic growth?
Well, I think on the inorganic side, we are not so much looking at the automotive, because the automotive we can do from our own. We invest heavily in our own capacities, right? But inorganic growth, we did this now with the air conditioning because of the heat pump business, which is also transforming the industry. And there, in this non-automotive side, always we are quite active. You saw that also with the building integration, where we acted in Canada and the northern US with Paladine. And that's the right way to do it, because this is the moves we need to do to shift more to North America, to shift more to these non-automotive businesses. The automotive, we are strong enough to shape this ourselves.
Yeah. All right, well, listen, Stefan, Hartung, thank you so much for your time today. I really appreciate really going around the world and around the different industries that Bosch is involved in, which is, again, in half of the world's smartphones and in literally every single car. So really a very sort of thorough appraisal of sort of demand in the global stage.
Yeah, certainly something we're going to be keeping an eye on. Crucial that he said that he's pivoting more towards the United States because of the strength, but even in terms of that investment supply chain. Bloomberg's Oliver Crook in Berlin, they're speaking, as he said, to the CEO of Bosch, Stefan Hartung. Coming up on the program, we are just over a week away until U.S. Election Day. We're going to take a closer look at what's at stake for Europe's trade relationship. We have the perfect guest here, Peter Chase, senior fellow at the German Marshall Fund, who, of course, has served in Washington in pretty senior roles, walking us through what's at stake, how you deal with them, what these negotiations could actually look like, regardless of who is in office come January 20th. That conversation next. This is Bloomberg.
We have 9 days until we decide the future of our nation. I see remarkable acts. I see a nation determined to turn the page on hatred and division, to chart a new way forward.
And I'm announcing a new policy today that I will support a tax credit for family caregivers who take care of a parent or a loved one. It's about time that they were recognized.
Former President Donald Trump and Vice President Kamala Harris campaigning over the weekend there. We are just over a week until Election Day in the United States. We want to zero in on the topic of trade. It's all part of our daily series focusing on the issues facing Europe in the battle between Kamala Harris and Donald Trump. Take a listen to what Oliver Crook had to say as he explored the different scenarios of what it could mean for the world's largest bilateral trade and investment relationship.
The United States and the EU have the biggest, most integrated trade and investment relationship in the world. There's no free trade agreement between them, but at about 3%, they enjoy some of the lowest tariff rates anywhere. Last year, the EU and US traded 850 billion euros of goods, with Europe running a surplus of about 155 billion euros. Meanwhile, trade in services was worth more than 700 billion, where the US runs a surplus of about 100. Combined, the exchange of both goods and services is bigger than almost every single European economy on its own. Kamala Harris would likely maintain the transatlantic status quo, though she's been vocal about favoring domestic production with government support. Donald Trump holds a different view.
The most beautiful word in the dictionary is tariff, and it's my favorite word.
Goldman Sachs says Trump's 10% minimum tariff would reduce EU exports by about 150 billion euros every year, shaving off about 1% of European GDP. Germany would pay the highest price. This year, the US replaced China as Germany's biggest trading partner, and a Trump victory could cost Germany 15% of its exports to the US.
Our allies have taken advantage of us more so than our enemies. Our allies are the European Union.
For everything at stake in the US election, as far as Europe is concerned, trade is near the very top of that list.
Joining us now for more on this topic, Peter Chase, Senior Fellow at the German Marshall Fund and former Vice President for Europe at the U.S. Chamber of Commerce. Peter, a pleasure to have you on the program as always. As we heard our correspondent Oliver Crook there talking about this trade relationship, which it feels like is on ice right now, given this bipartisan acceptance that tariffs may be the way forward on China. In terms of the overhang on the EU, it feels like quotas is where the Biden administration has leaned instead. Peter, talk to us about the effectiveness, the efficacy of tariffs versus quotas.
It depends on what you're trying to achieve. I mean, what a tariff does, it makes it more expensive for someone in the United States to import a good from Europe or anywhere else. A quota is an administrative arrangement, and just in being that is even more, to me, inefficient economically. But what you were just describing, the tariff versus quota debate, is what happened in steel. The Biden administration converted a lot of the tariffs that Mr. Trump had placed on European steel and aluminum into a quota system.
When it comes to the impact, though, Peter, can you just give us some numbers, some thoughts here about what this kind of damage could be? I know you've been very vocal in some of the other trade policy magazines as well. Talk to us about the impact, the danger of what that tariff imposition could look like come January.
You know, you had a very good opening that talked about the strength of the U.S.-European economic relationship. The thing that's really important about it is that it's an investment-based relationship, not a trade-based relationship. So that you have American companies have invested over $3 trillion in the European Union, whereas European companies have invested about $2.7 or so trillion in the U.S. economy. That's huge. A lot of our trade flows from those investments. It's intra-company trade. So anything that gets in the way of that trade relationship weakens the global competitiveness of U.S. and European firms. We are each other. BMW is the largest exporter of cars from the United States. That's a good thing. So when you try to put something like tariffs on that, you're actually weakening the global competitiveness of all of our workers in the United States and in Europe, where we both have very good labor law, we both have very good environmental law, and it's not something that strikes me as being wise.
Peter, good morning. It's Tom here in the studio.
Is China.
Yeah. Peter, the problem is that message is not cutting through to what could be the incoming Trump administration. Top line, is the EU bracing for a trade war? What are they doing?
I think the EU is being very clear that it is quite possible Mr. Trump will come in and that there will be I'm not sure it's a trade war with Europe as much as it's Mr. Trump's war on trade. And those are two different things. They feel in a lot of ways Europe will be collateral damage to a Trump trade war. They feel that what he does is going to be illegal under WTO rules, which it would be. And so they're prepared to strike back. They're thinking very much of their own economic security here. I think that the question that they want, or that they're trying to answer, that they're trying to pose to people in Washington is are we, Europeans, the problem, or is China the problem? Do we, Europe and the United States, need to work together to try to address the challenge that China presents? And I think that they've tried this before with Mr. Trump when he was in office, and I think there was some resonance for it. But there's no question that Mr. Trump and his economic policy team do think that the Europeans are taking advantage of the United States.
Yeah, he was very clear in that interview with John
demonstrated by the very
Micklethwaite
large
that he
trade
thinks,
surplus.
Yeah, that he thinks the allies of the US, and he name-checked the European Union, is taking more advantage of the US than their competitors or their enemies, and if you put into that bracket China. And of course, they're looking at maybe 60% tariffs on China. What would be the impact in terms of trade flows from China to the EU in an environment where we have 60% tariffs on Chinese exports to the US?
The Europeans are very, very concerned that a trade war between the United States and Europe that's exacerbated by Mr. Trump, although the Biden administration has added some tariffs to trade with China as well, that will deflect China's exports from the United States to Europe. And that almost compels Brussels and the European Union to raise barriers to imports from China because, again, the Europeans have understood the problem with the Chinese economy and the distortions in the Chinese economy the same way we do. And again, that's why they feel it's a little bit unfair that Washington goes ahead and does things with China that come at the expense of the European economy. They don't consider that really the action of an ally, and I can understand why.
Peter, how different do you expect Kamala Harris's approach to trade to be from President Biden's? Of course, there's been a degree of continuity from Donald Trump to Joe Biden. So what about if she wins?
One of the things that I think Mr. Biden emphasized, that Mr. Biden kept in place many of the trade measures that Donald Trump had instituted during his presidency. One of the things that I think Mr. Biden emphasized is the need to both build the U.S. economy through his infrastructure and CHIPS programs and things like that, but also to help American workers retrain and move, education bills that he was promoting. I think that Kamala Harris would actually continue that. I do not think that she would be able to remove the tariffs that have already been in place. But I do think that one thing that she might do that could be very important would be for the United States and Europe to be looking at the distortions in the Chinese economy together and working as together, not just the two of them, but building an alliance with a lot of developing countries to address China's chronic systemic overcapacity. That would be a major move forward. And I think here Mr. Trump would not do this. I don't think he would try to build a coalition of countries, including developing countries that are also afraid of China's overcapacity problem. There, I think, is probably the one place where Kamala might do more than Mr. Biden has done.
I've also seen a lot of public defences of Catherine Tai. Do you think that suggests that her position is under threat if Kamala Harris wins?
I'm not sure about that. I don't know. I don't know the relationship between the two of them. Catherine Tai has not been a trade representative in the mold of many trade representatives. She's not been out there trying to open markets for U.S. exports because the trade-off is normally seeing that we make our own market more open to foreign countries. So I think that there are some people who feel that Catherine Tai has been a little bit passive as a trade negotiator. Kamala Harris, I think, might want someone different in the post, but that may not be a commentary on Ms. Tai. I think that Kamala Harris, as a senator, voted against the USMCA because she felt that even with all of the work that Catherine Tai did, working with the Democrats in the House to improve the labor and environmental provisions of the USMCA, Kamala Harris, at that time did not feel that it went far enough in that direction. So I'm not sure really that a change in leadership at USTR would actually be normal to me. I don't think it would be necessarily an adverse commentary on how she feels about Thai.
Peter, at the start of this interview, you mentioned the trade from BMW in terms of European exports to the United States. I'd like to talk about that in reverse, especially when it comes to energy exports. Of course, we know the United States is a major oil exporter in terms of light crude, but it's also becoming a major exporter of natural gas as well, specifically to Europe. It's something that it feels like the Biden administration has been partially supportive of. The Trump administration certainly has. What could get in the way of that, do you think?
U.S. exports of energy, coal, primarily oil and natural gas, to Europe will continue growing. I have no question about that. I think that that is inherent in the disruption that has happened between Russia and the European economy because of the Russian invasion of Ukraine. So I don't think that either Biden or Trump would change that. Trump, if he really affects trade with Europe by imposing a general tariff, could very well find that the Europeans start scrambling to look for other suppliers of energy from the Middle East. That's difficult when the United States is the largest producer of oil and gas, which it is now. And I think that our exports have been very much part of supporting the European economy through this geopolitical problem that's been caused by the Russian invasion. By the way, I should say that my point at the beginning was that BMW is the largest exporter of cars from the United States, which is a little bit different from what you just said. And I think that it needs to be given credit as a major exporter, a foreign firm as a major exporter from the U.S.
It's certainly something we're going to be keeping a very, very close eye on. Peter Chase, Senior Fellow at the German Marshall Fund and former Vice President for Europe at the U.S. Chamber of Commerce, not to mention a career politician over at the State Department as well. We appreciate your expertise. Coming up on the program, we're going to continue a little bit of that conversation in the energy space. Brent slumping, after Israeli strikes on Iran-avoided crude facilities. We are going to discuss more of that next. This is Bloomberg.
Look at two different drivers that we see currently causing impact. One is on the consumer side, because we also have a consumer business in China. We have seen low consumer confidence translating into lower sellout, and leading up to the big day 11/11, which normally is a massive sales event in China, we see actually that the sell out towards that is expected to be low, and therefore also reduction of sell-in volume. So that's consumer side. Then on the healthcare side, we see the anti-corruption campaign continuing to have an impact on slower growth in China, and the visibility of moving forward on that is just low.
And that was the Philips CEO, Roy Jacobs, speaking to me earlier. That stock is amongst the largest losers of the session so far, down 16% on the cut to the outlook for the full year. And Roy Jacobs outlining the impact of China, where sales actually in the quarter dropped 2%. The outlook now for growth for this business, they're looking at sales growth of around 1.5% full year. That is down from almost 5% in the previous projection. The stock down, as I said, 16%. That's wiped off about 4 billion euros from the market cap of a company that is going through this restructuring and refocus. He did talk about strength in other markets. He talked about strength in terms of margins. But again, the lack of visibility when it comes to China, it's an anti-corruption crackdown, which is sending chill winds through that sector, with slowing growth combining to see that effect on Philips. And it's a reminder that European companies remain exposed and vulnerable to the slowdown in the Chinese market, guys.
OK, so Philips down this morning. Also in the doldrums are energy stocks, hence the FTSE 100 underperforming the rest of Europe this morning. You've got the likes of BP and Shell down more than 1.5% currently, and it comes back to the oil price. down off the back of Israel striking military targets across Iran over the weekend, but avoiding those crude facilities, so raising the prospect for easing hostilities in the Middle East. Let's get more now with Bloomberg Middle East, North Africa and Russia team leader Paul Wallace. Morning, Paul. I wonder how you analyse the choice of Israel to strike but not strike oil and nuclear facilities. Is this actually perhaps a victory for US diplomacy?
Hi, Lizzie. In many ways, it does look like that. And I think regionally, if you look at Arab states, and yes, probably the US too, according to what officials have said in the aftermath of Saturday's strikes, a lot of them think that this back and forth between Israel and Iran is over for now. That based on Iran's reaction, it looks like it's willing to more or less draw a line under this saga, at least until there's something new that happens. I think it's worth, and definitely oil markets think that with Brent being down around 4.5% today, but it's worth noting that Iran hasn't ruled out a retaliation of some kind, and there's certainly some Israeli officials that are expecting it to do something pretty aggressive. So we're just going to have to wait and see. But I think the answer to your question is yes. I think the US would be pretty much breathing a sigh of relief right now.
Talk to us a little bit more about that Iranian response as well, Paul, especially in the context of ceasefires when it comes to Gaza and Lebanon. What is the likelihood of that now?
I think it's still a big if as to whether we get a ceasefire in Gaza and or Lebanon before the US elections next week. There was a bit of excitement around Wednesday or Thursday when the restart of the Gaza talks was announced. The talks are ongoing in Qatar at the moment, and Israeli and US officials are there, the head of Mossad, the head of the CIA. However, there doesn't seem to be much excitement, if you like, from the Israeli side. And even Hamas is so far playing down the likelihood of these talks leading to much. There's still a big gap between Israel and Hamas in terms of reaching an agreement. And a lot of people, including within the Israeli government, think that the IDF should continue pressing its military gains, that it's on the front foot, and that it would be detrimental to the country's security to agree to any ceasefire and truce at the moment. So there's still a lot of obstacles before we get to an end of fighting in Gaza, let alone Lebanon.
OK, Paul, to the oil markets right now. Brent down 4.5%. What, in your view, what are the analysts saying about what's being priced in and what's being priced out of these energy markets?
I think what is no longer being priced in, and that's why we're seeing the drop today, is that Israel didn't target oil export facilities or any oil facilities, domestic refineries, for example, directly. So I think that is the big thing that oil markets are looking at. However, there is still wariness, shall we say, among some traders, because it seems as if Israel took out some of the air defense systems protecting oil facilities, including in Khuzestan province, which is the sort of main oil province in Iran. Now, people are trying to interpret, does that mean Israel is sending a strong message to Iran that the next time it has to strike the country, it's going to take out those energy facilities, that it didn't do it this time, but it was just showing to Tehran that it has the ability to do that? It's very unclear at the moment, and for all that the latest to and fro between the two countries looks like it's probably over, it's by no means the case that tensions have died down between them have died down completely, and it wouldn't take much for them to be threatening one another again.
OK, Paul Wallace, thank you very much indeed. An important update, of course, out of the region. Bloomberg's Middle East and North Africa team leader. Kriti.
A lot to digest, of course, throughout the rest of the week as well in terms of what we're going to hear out of the Middle East. But then we've got plenty of other data points to keep an eye on as well. Tomorrow we do have those earnings kick off over in the States. The Alphabet earnings, the big tech earnings, are going to be crucial in terms of where the stock market goes and whether or not it really matches the message from some of the data points that we get throughout the week as well. We've got the JOLTS data as well coming out there, GDP data into the rest of the week, Wednesday, and then, of course, all leading up to the Friday jobs report, not to mention plenty of European data as well. And then I think the big event here in London, that UK budget on the 31st. Let's get a little bit more with Bloomberg's Valerie Teitel. She gets the fun job of monitoring all of it for us. So walk us through, in your view, the most volatile event of the week.
Look, I think the risk is that the market this week increasingly doesn't trade on any fundamentals, but instead is more driven by profit-taking on trades that have really worked nearly in a straight line this October. I'm talking about those Trump trades, U.S. yields higher, the dollar stronger, and then even the cross-market trade with the European growth weaker, U.S. growth weaker. We could just see a big profit-taking on those positions as we get closer to those elections because those trades are in the green. They've done well. An investor is probably sitting there thinking, do I really need to warehouse this risk over the big election night, or should I just take some profit, take some chips off the table as we head into next week?
Well, you're not seeing a lot of reaction in the French bond market off the back of the downgrade from Moody's to French debt. It's barely budging, really. Do you think it's actually going to be quite a quiet week for bonds, also in the UK, because the action happened last week?
Look, I still look at the European bond market. Yields are still higher across the sphere, and we don't technically see that on a day where oil is down nearly 5%. European fixed income normally does outperform when oil falls. We're not seeing that even in treasuries overnight, and we're not seeing that here in the open in Europe. So I think there are some jitters that are still out there, maybe not reacting so much to what Moody's said on France when it warned of their deficits climbing too much. But I do think there is some more nervousness out there in Europe and the US on the deficit story.
Well, 10-year, currently 428. 428. We fluctuated. There has been that volatility, hasn't there? And the sell-off is back in this session today. We have details coming out on Wednesday from the Treasury Department in terms of how much debt it will be issuing into the markets. How are you thinking about what is priced in? I mean, there's that volatility there. Then there's non-farm payrolls. Then there's the election itself. How should investors, or how are investors positioning along the curve at this point?
Look, the quarterly refunding announcements have driven a lot of attention based on, we know that the Treasury is borrowing more money. Where exactly are they going to tap that? Is it going to be in the long end, or is it going to be more in the short end?
So that's the question, is where they land in terms of on the curve and what they're issuing.
Yeah, that's okay. One key thing that's driven there. And then also, if this Trump trade does see a reversal, though, you could see a lot of that premium taken out of the long end of the curve. So especially in the 30-year sector in the U.S., we have seen asset swaps widen, which is more of a showing that investors in the market is more worried about Treasury supply. We could see a reversal of that if these Trump trades are unwound, and maybe that quarterly funding announcement that we do get on Wednesday, investors really do look past it.
It's going to be a fascinating week, of course, to watch the peaks and valleys that we see, of course, in yields. Bloomberg's Valerie Teitel walking us through all the data points of this week. A quick programming note, we will have an exclusive conversation with the CEO of Goldman Sachs, David Solomon, joining me at Tuesday at 5 a.m. UK time at the Future Investment Initiative event over in Riyadh. In the meantime, of course, we do have U.S. pre-market trading already kicking off. Futures over in the States higher by about 0.6%. A little bit of a mixed picture here in Europe. That does it for the opening trade. I believe the Bloomberg Brief is up next. Plenty to digest. Stick with us. This is Bloomberg.